Hello, everyone. Today on the final bar, we will wrap this week. We'll focus on what's happened as we wrap up the second quarter of 2022. And it's been a painful one of the worst beginnings to a year by 6 month period of any year in market history. We'll break down some of the action here on Friday, relatively quiet day, sort of drifting to the upside, which is pretty standard before a long holiday weekend. What does this mean next week when we come back from the 4th of July holiday? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. It's Friday, July 1st. Happy Canada Day. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. It's great to be with you here as we wrap this week. First weekend in July, heading into the 4th of July holiday on Monday. Wish you guys all a happy Canada Day if you're upstairs from where we're at, and happy 4th of July coming up this weekend for those of you in the U.S. A lot to talk about today, mainly because not necessarily about today's price action. You know, when you have the Friday before a long holiday weekend with Monday off, kind of standard playbook for this sort of day is a little lighter volume, a little less craziness, usually drifting higher. It's the junior traders sort of running things in the major houses anecdotally. So things are sort of like lighter volume and higher, but you can't draw a ton of conclusions from that. Sort of what we found today. Choppy through the course of the day, drifting higher into the end of the day. But again, reinforcing the defensive nature to what's working. Utilities, the number one sector today, up 2.5%. Technology, the worst performing, ended up just barely pounding out an up day, but not by much. So we're left with question marks as to what's going to happen next week. We'll look at a number of charts here together and see what we can find out. We have great guests on the show. I had a lot of fun this week talking with Samantha LeDuc and Sean McLaughlin. Had some great perspectives. I'd encourage you to go check out those interviews if you missed them. Coming up for you next week, again, we'll be off for the market holiday on Monday, and we'll do our normal Monday sort of show on Tuesday when we get back from the holiday weekend. Coming up on the 6th, we have Jesse Felder, editor of the Felder Report. Does a fantastic job with stock ideas. The week after that, on the 13th, Sam Burns from Mill Street Research in Boston. And then Carolyn Borodin, expert in Fibonacci analysis, will be coming on the show yet again. Let's continue on today's show. Let's talk about this market environment, how things have evolved as we wrap the week. We want to start off with a poll. We asked you recently on our social media accounts, on Twitter. Give us a follow there. Make sure you subscribe to our YouTube channel. You'll get all of these polls through those networks. Also on our live stream page, we asked you recently, where does Bitcoin finish the year 2022? And I gave you a pretty wide range, above 50,000, below 10,000, or between 30 and 50, between 10 and 10 and 30. Just over half of you, almost 2 and 3, answer between 10,000 and 30,000, which is a pretty decent answer. I did not vote in this poll. If I did, that's probably where I would have ended up. And the reason is this: when we look at the chart of Bitcoin, we've talked a number of times, and again, I apologize for my increasingly busy chart of Bitcoin. This shows you how choppy of an environment it's been. And I'm always trying to get a read on things by applying different, looking at different percent movements, applying different Fibonacci frameworks to see what can make sense and just how to get my head around what's happening here. But the bottom line is we've had a fairly consistent downtrend. If you look at what's happened in the last 8 or 9 months, it's been all about the key big round numbers. We bounce off of 60,000, we finally break down. We bounce off of 50,000, we bounce to 40,000, to 30,000, now to 20,000. So every one of these times, we've sold off to this next big round number and then consolidated there for, at times, 4, 6, even 8 weeks. And then we rotate to the next one. We're now about 3 or 4 weeks into this 20,000 range. And the concern I would have is if we break below here, what's next? 10,000 would represent a significant potential floor. That's a great area of potential support because that was a huge deal when we finally broke above 10,000 back in 2020. We bounced off of there and found support after the breakout that would be sort of a magnet price. I think that could make a ton of sense. The chances of Bitcoin going well below there and finishing the year below there, possible, certainly, just like getting above 60,000 would be possible. Likely, I would not think so. I think we'll probably end up chopping around and potentially pounding out a bottoming pattern, but most likely in that area. So I would agree with the 57% of you that said between 10 and 30. I think that's a decent year-end target. We'll see if we do get some sort of rally in the near future, which I'm not seeing yet, but if we would, I wonder how that poll answer may potentially change. Let's quickly just check in on what happened today. Then we'll look at the wrap of the week chart, focus on the last week's movements, and then we'll go on from there to the Mindful Investor live chart list. The S&P, finishing the day higher. And again, try not to read too much into the Friday before long holiday weekend. It's not usually a great measure of anything other than it's pretty light, and we're probably going to drift up a little bit. The VIX is back below 27, around 26.81. Interest rates coming off again as bonds go higher. So today you actually had stocks and bonds both going to the upside. Choppy for interest rates. 10-year yield not moving a ton from where it was yesterday, and currently just below 290. Commodity markets actually mixed, some of them higher, some of them lower. Precious metals, particularly silver, down from yesterday, and cryptocurrencies for the most part still moving lower. Jumped up quite a bit, and you had Bitcoin briefly going above 20,000 in the last 24 hours, but in the end sort of rotated back to the downside, currently around 19,250, just above there, about 19,300. Let's look at our wrap the week checklist, which would be here. Where am I at? Wrap the week. So what this is going to do is look at the last 5 trading days. We're going to start the clock back on June 24th, which was last Friday. We're looking at the next 5 days to see what actually played out here. Where were we at then, and where did we end the week? So in black, we have the S&P 500, another down week. So finishing the week, even with today's bounce, we're still down 2.3%. 2 of the asset classes we track here underperformed stocks this week, or large cap stocks. In pink, we have the NASDAQ 100 down 4.2%. The worst performer by far, Bitcoin down 8.8%. So no real change in that persistent decline in cryptocurrencies. No real floor that's emerging. And again, I don't blame you if you're looking at the chart of Bitcoin and you're thinking, this is a technology that's going to work in the long term. So as a long-term play, that makes sense. Full disclosure, I own it in a retirement account. So I get the logic of it. But from a tactical perspective, if I'm purely looking at the charts, hard to justify it when you continue to see lower lows and lower highs. And that's what Bitcoin, Ether are testing once again, are sort of those, those near-term lows here, and potentially making another new low for the year here next week if this trend continues. Everything else here outperformed the S&P too, not by much. So here we have small cap stocks, the Russell 2000, which was down 2.1%. In orange is emerging markets, which was down just under 2%. Gold finished the week down 1%. That's using the GLD. And the rest of these, the other 3 were all in the green for the week. In brown, we have crude oil prices, which were up 0.5%. That's using the USO ETF. The dollar ETF UUP was up 1%. And in red, bond prices using the TLT ETF, which was up 3.1%. So out of all of these different sort of major asset class ETFs, for the most part, it was bonds and then everything else. Bonds and the dollar and crude oil. Everything else was down, in some cases down in a big way. So this 1 week showing a rotation away from risk on and more into risk off. The ultimate risk on, which is cryptocurrencies, super speculative with not a lot of fundamental backing to it. Stocks, sort of the classic risk on lever, especially growth stocks, really underperforming yet again. So what's working? It's the dollar and it's bonds, right? Yields have come down here recently. Bond prices are coming higher. I wouldn't be surprised if we see more of that, because if people really start panicking, the most conservative sort of risk-free asset you could own would be some sort of treasury note or treasury debt of some sort. So would not be surprised if we get a bit of a reversion, a continued reversion away from higher interest rates, coming off a bit as bond prices rally a little bit. And in my conversation with Samantha LeDuc, kind of touched on those themes. If you missed it, go to stockchartstv.com. I would check that one out for sure. We finish off our Wrap the Week segment by looking at the Mindful Investor live chart list. As a reminder, these charts are always up to date, or kind of always up to date. I update them about once a week, but you can access them at any time from stockcharts.com. go to the articles tab, go to my page, which is called The Mindful Investor, and you can get to this list of charts. I keep them updated pretty frequently, and it sort of summarizes my overall view of the market environment, big picture in terms of price, breadth, and sentiment. My market trend model I update Friday at the close. I haven't changed the annotation yet, but I will as soon as I get around to it. The short-term model turning back negative. That's after last week being positive for just one brief week. After that, we've turned back to the negative side. So the short-term model back to bearish. The medium-term model has been bearish for almost all of 2022, except for a brief 2-week period there at the end of March. And the long-term model for me turned negative in May. So what it means to me, when the long-term, medium-term, and short-term models are all negative, it is just not a great time to be looking for stock ideas, right? At any point, I'm going to be open to them, right? And good charts in any environment are going to be interesting to me, because even when things are completely dismal, I was talking with Grayson Rose earlier today, we were talking about what charts in a down tape and a down market, what actually still looks pretty constructive, right? What is looking interesting to you? And we talk about things like that we've talked about on the show. We talk about healthcare, we talk about consumer staples, even utilities. All three of those sectors showing some decent relative strength here recently, continuing to do okay on a relative basis for sure, as the S&P, as the NASDAQ have struggled. But overall, this is telling me to think more about capital preservation than capital growth. My goal here is to defend against further market downside and not be aggressively looking for crazy new long ideas just because the conditions are bearish, right? I'd want to be bullishly positioned when the trend is bullish, and that is not what I'm seeing now on my market trend model, negative across the board. Daily chart of the S&P is an interesting one. It's been sort of a choppy month of June now that we're going into July, right? June was kind of crazy. You had sort of this narrowing range during the month. You had the highest point in the first week in June. You had the lowest point sort of mid-June. And from there, you've made lower highs and higher lows. You've sort of consolidated around sort of that 3,800 to 3,850 level. This is a bit of a narrowing of the range, but overall, the trend has been downwards, right? And I think that's the main thing that hits me. Earlier today, I was recording the monthly chart review for my Market Misbehavior Premium members. It's a monthly exercise to take a step back and look at the big picture trends. And, we talk about when you take a step back on a lot of the individual macro charts, I'm just struck by the downtrend, right? If you look at Brazil, if you look at even China, which has bounced a little bit recently, but still kind of in a downtrend, and the S&P chart, no different, right? So as long as the trend continues in the form of lower highs and lower lows, the trend is down by definition. When I'm looking at breadth measures, there's not a lot to get particularly excited about. And the advanced decline lines, I think, tell that story very well. In the last couple of weeks, all 4 of these have made new lows for the year: large cap, mid cap, small cap. That environment is a negative environment. Just to finish off here briefly, 1 or 2 more charts. New lows in a bear market, you have an expansion in new lows and an evaporation of new highs. In a bull market phase, you have an expansion of new highs and an evaporation of new lows. It's all about where you need, even if the S&P is not making a new 52-week higher low, you need individual stocks that are able to do that, because that indicates enough buying power that's most likely going to push the indexes to follow that trend. There's a lot of red in the last 8 weeks and not a lot of green. And that tells you that in any area of the market that I'm looking, it's all about the new lows. And as we've started to roll over again this week, you're seeing the red histogram start to increase yet again. I'm concerned going into next week that we see further downside to be had here. Again, get excited when those red bars disappear and you start to see a little more green on the chart. That would be a sign to get a little more encouraged. We need to take a quick commercial break. We'll be back with our next segment, Power Up. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's fun to do this show every day, and we really appreciate you tuning in and following our work as we try to break down these markets and empower you to use a platform like StockCharts to make some hopefully really good decisions about your investment portfolio. A couple quick announcements before we continue on with the show. First off, We welcome your comments and we welcome your feedback, but we particularly welcome your questions. We're going to do a mailbag segment a little later in today's show. We would love to answer one of your questions in our next mailbag, which will be early next week. You can get your questions to us a couple ways. Via email is the best way, thefinalbar@stockcharts.com. Send us a chart, an image of the chart, or ideally from StockCharts, just send us the chart link, the permalink from the chart you're looking at. That's the great way to get your ideas in front of us, your questions, because we can see exactly what you're seeing. You can also tag us on Twitter at FinalBarSCTV or on our YouTube channel. Just put a comment below the video you're watching there. We'll gather all those questions. Hope to answer one of yours live on the air. Next week's show and our next mailbag. Also go to StockChartsTV.com. That is our on-demand platform. There's so much great content on there every week. I'm super proud of the StockCharts TV team, really working hard to every day give you some new ideas, some new perspective, and some great expert commentary. Go to StockChartsTV.com to access all of our previous episodes and interviews, or on your mobile device, just search for StockCharts TV on demand. Our next segment is called Power Up. What we love to do is highlight some of the really cool parts of the StockCharts platform. There's so many capabilities on here. I've been using StockCharts for a number of years, but really since joining as the chief market strategist, I have immersed myself in StockCharts as much as possible. And I found a lot of really cool tools to share with you. And so I want to share with you today what we call the UDI, which are the user-defined indexes. This is not super sexy, but it is super, super cool. And I'll tell you why. Here's what happens. We have a ton of data, a ton of market data on our platform. We have listed equities, some futures, commodities, currencies, a ton of ETFs. And the good news is between stocks and ETFs, you can pretty much track any asset class or any particular theme that you're looking at through ETFs and individual stocks and indexes. So we have you pretty well covered in terms of different asset classes. But what if there's something we don't have? That's where the user-defined indexes come in. If you click on that, from that charts and tools part of the website, this looks pretty simplistic. It's pretty much a table of data, super boring, but really, really powerful. I was doing some work at the beginning of this year where I wanted to look at the Fed balance sheet. We're starting to mentally prepare for the fact that the Federal Reserve was going to be becoming, the FOMC was going to be becoming, a little less accommodative, a little more restrictive, sort of changing from being full on, liquidity into the market to be turn off the faucet quite a bit. So I wanted to look at the Fed balance sheet. So coming from the Federal Reserve website, I could download all of that data for free. I put it in a CSV file. I imported it right into StockCharts using our user-defined indexes. I gave it a ticker. So anything with the little @ symbol, that is something that you've created. You just need to click on New Index, and it'll give you some of the ways you can do it. You can upload data. So you can keep this updated as you want. If you bring in new data, this is great for long-term data sets, economic data, even portfolio returns, a custom index you've created elsewhere, any of that stuff, as long as you can get dates and values into some sort of spreadsheet format, you can import it into our platform. Then what you can do is view the chart. Now, chart look isn't great because that's sort of my basic equity chart, but I can change this and just show, the current data on a closing line. And I have taken the Fed balance sheet from the St. Louis Fed, taking it off their Fed website. I downloaded it into a CSV file. I uploaded it into StockCharts using this ticker that I created. I can now chart it along with the S&P, along with whatever else that I would want to do. This is a really cool way to tell whatever stories you want to tell, to understand the relationships between different data sets, especially something that we don't cover. Now, if there's something that you can't find on StockCharts and you think we should have, make sure you hit our support desk and let us know what you're looking for, because we're always looking to improve the data we do have. But it's something we don't, and it's something you can get into an Excel spreadsheet. You can easily pop it into the StockCharts platform. That is our Power Up segment. The user-defined index is found from the chart and tools page. Let's continue on today's show with our final bar question number 1. Financials, the XLF, are lagging in this environment, but why? Wouldn't a hot jobs market with higher wages and interest rates increasing be good news for the sector? Great question. And so yes and no, right? I mean, the answer is, yes, if you, all else being equal, if you told me, here's the scenario, here's what the conditions are going to be, our financial is going to be a pretty good bet, I would probably answer yes. But this is the big difference between what should happen and what actually does happen. And this is where technical analysis and charting really is so important. One of my senior analysts in my Fidelity days used to say, charts are the truth serum for the market. Investors love to deal in certainties. Gold goes up when stocks are struggling. If interest rates go up, it's good or bad for this particular sector. When this sector does well, this other sector should probably not be doing well, and all these sort of simple relationships. At the end of the day, the markets are a complex system of a bunch of different variables. So while everything you said is pretty good, right? Jobs are pretty decent in terms of the fact that there's a lot of hiring that's trying to be done. Wages are being forced to go higher. Interest rates are increasing. That's true. But we also have the other side, the ugly side of that, which is inflationary pressures and what it means for the consumer. The fact that the Fed has completely changed course from being super accommodative to much less accommodative. And as a result, the yield curve is actually fluctuating quite a bit. While interest rates are going higher, it's not like the yield curve is steepening aggressively. And that would be maybe the one thing you didn't mention that I think is probably hitting financials the most. So if you look at the relative strength of the financial sector, go back to the first quarter of 2021 and where we're at now, you haven't done much better than owning just the S&P and financials have pretty much been in lockstep. You had mentioned they're lagging. They're not really lagging in the last couple of months. They're actually pretty much in line. The relative strength line is kind of sideways here, right? Since early April, it did come off in the first quarter. That's totally fair. When financials originally was sort of selling off from their high in January. From there, it's kind of moving lower along with kind of everything else, right? The average stock is kind of looking like this too. And it looks like some of the more growth-oriented sectors of the market. So my concern with the financial sector is the fact that the yield curve has not been steepening. It's still actually relatively flat relative to historical standards, and at times is almost inverted. That's not a great look for the financial companies, particularly banks. It's actually pretty tough. It's the opposite of what they are looking for. In general, higher rates usually lines up pretty well with higher financials, especially on a relative basis. It's just not played out this way this year. That is, again, my long-winded way of saying I would always focus on the charts, right? The reasons why certain sectors have outperformed or underperformed usually make a ton of sense looking back, right? If you look back at the end of 2022, it's going to start to make sense because you'll be able to understand, all right, this worked and this didn't. What was actually going on in the heat of the moment? Right now, if you're analyzing the markets, I would look at the charts, and the chart of the financial sector is telling you it's not a great place to be right now. That's why I find technical analysis to be so valuable. Question number 2, how to interpret the stock chart of PGR, property and casualty insurance industry, the best performing industry, even in a down market, and outperforming both the S&P or the financial sector. I would totally agree. When we did our stock draft, our stock charts draft back in April, I think it was JC Peretz. He had 2 picks. He had the turnaround pick 12, and then the end of the first round, the beginning of the second round. One of his 2 wasn't Progressive. I think it was Allstate. So similar kind of idea, right? PGR is one of the better charts out there. If you're looking for just generally what charts are holding up when the markets are down, right? What stocks are not making new lows every month while the S&P and the NASDAQ are doing that, and a lot of growth stocks are. Insurance companies are a pretty good part. And if you had to be in an area of the financial sector, no doubt I would probably be either in insurance companies like PGR or maybe things like CBOE, sort of those specialty finance kind of, market data provider types of names, which are doing okay too. But PGR is a pretty good chart. What's most encouraging about this chart is the relative strength at the bottom. And in a down market like this, stick with names that are working. In a market when most stocks are going down, find stocks that are making higher lows. I think a chart like PGR is pretty decent. And again, while most stocks and the markets themselves have a negative range, a bearish range for the RSI, this one's actually hanging out in the bullish range pretty good. A great chart and a great example. I think that's overall setting up very nicely, particularly at a time when most stocks are struggling. Decent chart. Next question. So if in a multi-year bear market, is the money in high dividend stocks with capital preservation? How can stock charts find these stocks and monitor the stock's return versus capital erosion trends? That's such a great question. So we're limited in terms of what our capabilities are only because our business traditionally has been stock charting, where our goal is to help you chart stocks. And we have limited fundamental data for you to be able to consume and use. We are actively building that data set out. And so hopefully over the coming months and years, you will find more and more that you're able to chart fundamental data very effectively on our platform. We have limited stuff you can do like dividends and earnings and things like that. But getting into other things in terms of how companies are actually managing their capital, key ratios and stuff to understand their cash position, is a little deeper than what we're able to do. But I will tell you, we are able to certainly screen for high dividend stocks that are in good constructive patterns. That's what I'd probably point you to. If you go to our scanning engine, which you can access off of our dashboard, I have a scan, which is, my scans are super simplistic. So I have one called dividends with an exclamation point. I guess I was very excited to search for dividends at some point. I'm basically saying I want a StockCharts technical ranking over 80, which means it's in the top 20% of stock trends across our market cap tiers. I'm only looking at stocks above a 10 billion, sort of like the larger than mid cap and up. And I'm just looking at members of these particular indexes. So I've kind of tweaked this with a couple different arguments. I might take that off just to make it a little broader of a universe. So I'm saying a market cap over this, yield over 5. Yeah, the problem is that's going to include a lot of non-US stocks potentially. So yield over 5. That command is actually looking at dividend yield. That's what we're doing there. And at the bottom, if you're not sure how to use some of these, just use these drop-down menus. And if you go under ticker properties, you'll find things like dividend yield and PE ratios and stuff like that. If I run the scan, I didn't look at this earlier today. Yeah, not a lot, because I'm saying I only want high dividend payers that are in the top 20% of the scooter rankings and above a certain cap tier, which means it's not much. You've got 3 stocks here. Philip Morris, which has been a tough name, but not bad, right? I mean, the fact that it's kind of holding up while other things are coming down is pretty tough. That's showing a yield of 5% right now. What else would I have? AT&T and Williams. Williams is in the energy sector, which has come down a lot. AT&T, talk about a surprisingly constructive chart here. Now, this is adjusting for dividends, so it's showing the nice rotation, but the relative strength is beautifully strong, which is what's really interesting to me. Our adjusted database, which we use as a default for stocks, was something John Murphy decided on years ago because it helps you use technical indicators, incorporating just the relative performance, including all that, adjusting for all that non-technical stuff and just focusing on the behavior of investors. And overall, it's showing a bit of a nice positive rotation for AT&T. Might be an interesting idea there, and on a decent yield, one of the higher yielding names you'll find certainly in the S&P 500. That's it for the mailbag, and thanks so much for keeping the great questions coming. We need to wrap the show. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market. Here is chart number 1. Whoops, that's the candle glance view. Let's go to this one, chart list. Chart number 1 is looking at the New York Composite Index. I actually didn't get to one of the questions in our mailbag, and I'll try to do it in our next mailbag segment. I was asked about breadth indicators and looking at breadth data with some different slices. We have a lot of different breadth indicators on there. And I will tell you that one of the real initiatives we'll be focusing on, we're actually building out our data team here at StockCharts. And hopefully adding some capabilities to help us really upgrade our breadth data. We have a ton of data. It's just in a lot of different places. The best thing to do now is search through our chart school pages, look for articles by some of our great contributors, because they feature some of the best charts that highlight the strength and the depth of our breadth data. This is one in particular. It's looking very simply at the New York Composite Index in the top, which are all the common stocks listed on the New York Stock Exchange, and the AD line for the New York Stock Exchange with the common stocks only as well. Both of these are consistently making new lows, and they're both coming off of a new 52-week low last month in the last couple months, right? Last couple weeks ago. As long as these indexes, these lines both keep making new lows, the trend by definition is down, and the breadth by definition is negative. Chart number 2 is NVIDIA. I talked earlier this week about what I proposed as the Manamana group, sort of taking the 6 FanMag stocks, but adjusting for the new names and adding a couple others. The only good idea I had on YouTube was the Manana stocks. I don't mind that, but I have too many M's for that one. So I'm going to stick with Manamana. Keep them coming if you have other ideas or suggestions. But NVIDIA and Adobe are the 2 that I added to get to those 8 names, tickers MANA, MANA. And I look at NVIDIA. It is the first one out of those 8 stocks making a new 52-week low in July. Congrats. First trading day in July. We've got our first new 52-week low as semiconductors have struggled, making a new relative low. That's not a great look for the overall markets, by the way. Finally, healthcare. One of my recent guests, Mariella McGonigal, was talking about healthcare when we talked on the show. Go back to that interview on stockchartstv.com if you missed it. She made some great points about areas like pharma and biotech. I'm noticing the XLV is making a new relative high. Utilities, consumer staples, looking strong on a relative basis as well. Folks, that's a wrap for this week. Thanks so much for joining us every weekday after the close for the final bar. We'll be back live on Tuesday. Have a great, happy 4th of July. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. We'll see you on Tuesday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.